Hello everybody and welcome to another one of IRONSHIELD Financial Planning's Fly on the Wall webinars. My name is Scott Plaskett and I'm a certified financial planner and the senior financial planner and CEO of the fee-based financial planning firm IRONSHIELD Financial Planning. If this is your first time tuning into a Fly on the Wall recording, let me quickly explain to you what this is. You're going to experience what it's like to be a fly on the wall during one of my update calls with a member of our Top Guns network. This network is my personal network of specialists. Every so often I ask a member of my network to touch base with me to bring me up to speed on the latest happenings in their area. And when they call me, I record the call so you can be a fly on the wall for that call. In today's episode, I have an update call with Charles Wilton, a portfolio manager at Raymond James Limited, a Canadian subsidiary of Raymond James Financial. Raymond James is one of the most respected investment management firms in North America. I love speaking directly to portfolio managers about their process. Process is so important to investing, and when I can get a portfolio manager to explain their process in plain English, we all benefit from this wisdom. Now, here's the call. All right, Charles, thank you so much for taking the time today to really just chat about some new acquisitions or a new acquisition that's now in the portfolio or in your portfolio, and it's a company called Gilead. So I thought maybe we just do a bit of an overview as to why you bought Gilead, what the company is, sort of give people a bit of an insight as to what the company is, but then really more importantly, why you bought it, why now? What was it that motivated you to acquire it and bring it into the portfolio? And so I'll just let you sort of take over from there, and we'll take a look at what you've got to say.
Okay, thanks, Scott. Well, Gilead Sciences, it's a massive biopharmaceutical company that discovers and develops and commercializes innovative therapeutics in areas of unmet medical need. So it's a real up-and-coming kind of business. And their portfolio is a pipeline of investigational drugs and proposed drugs that deal with HIV, AIDS, anything to do with liver, cancer, inflammation, serious respiratory and cardiovascular conditions. And they're a leader in all these areas with numerous patents in place to ensure that they get full control of the market. So it's a $156 billion company, and they have, from a patent point of view, it's almost like an IBM. They just create more and more and more patents. And the company has had tremendous growth. And I've looked at the company, and each one of these drugs that they discover, whatever, they're Hep C drug. The first year they brought in $12 billion for the drug. So we all know in areas of healthcare and immunology and genome tracking that the large pharmaceutical companies are actually engaging biopharmaceutical companies and other ones to do the work, and then of which case they would either buy in on an option basis by the company or take a commission kind of for the drugs. So we see a lot of the big discoveries that have been coming up recently have not been by Merck and that. They've been by companies like Gilead. They're really wonderful businesses. Problem is that the expectations have been very high with this company all the time. And as we've talked about before, yes, we want a good business, but we don't want to overpay for good business. We'd rather watch the good business, and if the good business gets to the point where we think that it's attractive, then we buy it. And then if it gets unattractive because the market's expectations are way too high, then we sell it. And then, we might be in this company a couple of 3 times over 5 or 10 years.
So with this company, then, so you say, so you found Gilead, and it's what you would consider a great business. But how long have you been watching it for?
4 or 5 years.
Oh, really? So it's been sort of on your wish list for a while, and
it's been on, Home Depot, Walmart, and Coke were on my wish list for 8 years.
Right. All right. So patience is important.
Well, it's a thing. It's like walking to the subway every day. You go walk 2 blocks, and every time you go by this house, there's a 57 vet sitting there for sale. And every time you go by it, you look at it and say, oh, God, I'd love to have that car. But the guy wants way too much money for it. And you keep walking by, and then eventually there's a sign, have to sell cheap because of some problem. You go in there and you buy it and think, God, I love that.
Yeah.
So it's like Nike. We got rid of Nike, but we hope to buy Nike back. So it's really, as I've said before, it's really a question of, it's mostly about the price. So we deal in good businesses, and then, but the price has to be the most important factor. And so Gilead's going on, and things are great. They have tremendous, their revenue growth over the last 5 years is 12.5% a year. Their economic earnings have been running about 30% a year.
Mm.
Then so what came up was a little bit of a hassle with their Hep C drug, where they were dealing with another company, and what they did is they got into a bit of a price war. So Gilead was going to drop, or had to drop their price, and so Express Scripts went with AbbVie, which is one of their, it's a big company too, and it has a Hep C, but they're not really direct competitors. So the stock dropped by 15%, and seeing it drop by 15%, that was great. So that's why I bought it.
So basically, it finally came into to the right price range.
Yes, and what it did, it came into the higher end of my price range.
Okay.
So what the market is, it's the upper end of my price range. But here's always the rub is that you get a really good business, and you like the business, you understand the business, how much do you pay for the business? Well, there's going to be a certain cutoff, and, it's more art than it is science in a lot of ways. So if I have an opportunity to get a hold of a company like Gilead at that price, that's my 57 bet.
Right. Yeah,
so given what we paid for it, and given the potential of this company, we might be owning this company for years. Yeah, another thing is that we don't often get real hammers, a real massive stock drop in a good business. So if we get a big market correction, of course, then all the quality moves down. The quality goes down with the other stuff as well. But it's not very often that you get a chance to get a really fabulous deal for obvious reasons.
Yeah, like 2008 when everything crashed, there were probably some fabulous deals at that point, because it was just such an emotionally driven marketplace that there was no logic or rhyme or reason for why things were dropping to the extent that they were. So there were some fantastic deals, but now we're living in a time where the markets have done quite well. Things have moved up, so trying to find those massive deals in a very, very boisterous market can be, I would think, be very challenging.
Well, it is. It's more challenging, and the reason the market went down in 2008, amongst other reasons, basically fear. So people are just trying to jump out. When people are fearful, what do? They sell the most liquid assets first. Mm-hmm. And as the market starts moving up, well, it's like anything. That's why when I say when the market gets a real hammer, I love it.
Yeah.
No, because when you walk into the subway, there's the 57 vet, there's the 56 vet, and the 55 vet, and they're all saying, buy mine, I'll give it to you cheap.
Right. Okay, so this is really an opportunity that presented itself, because you knew the company, you've been watching the company for a while. Your original analysis was that the company was priced at a range higher than it should have been, and all of a sudden, its price dropped to within your range, higher part of your range, but within your range, where it said, this is an opportunity.
Well, it is. And to give you an analogy, the greatest investor, most people would say, was Benjamin Graham, and of course his pupil were Charlie Munger and Warren Buffett. Mm-hmm. And when they started their own business, their own fund business, their own companies called Berkshire, Buffett was a strict proponent to Benjamin Graham, and Benjamin Graham was cross the T and dot the I, and if you didn't have this, you couldn't buy it. And Charlie Munger sat Buffett down and said, Warren, you're way too rigid on this kind of stuff. There's no way that you're going to be able to get net working capital companies all the time, especially their companies. You're going to have to be a little more flexible in paying a little bit more for really good businesses. So it was that point that he changed his point of view because Munger had a big influence on him, and that's when he started buying Coke and buying other stuff. So he understood good businesses, and you just keep adding to good businesses. So it's not out of a black box that this is so rigid. So you understand what the possibilities of Gilead are in any month, what could happen. But the other thing of buying biopharmaceutical companies or pharmaceutical companies is yes, there's a pipeline there, and what if they don't get anything, or what if they're overpriced? So you have to have some faith, which is why, I don't buy tech stocks, but we bought IBM. And if we're going to buy a pharmaceutical company or we're going to get into this type of industry, Gilead is the Warren Buffett of the business.
Right. Yeah, it makes sense. Okay.
Because there's Allergan, there's all kinds of other stuff out there that I've watched and I've looked at, but I just don't feel as comfortable. Remember, we talked about margin of safety. I worry about the margin of safety, and I feel happier now that Gilead's in the fold.
Thank you for listening to today's call. If you require further information or have a question relating to today's call, please go to the comments section in the show notes below. Ask your question or make your comment and we'll respond directly online. If you would like to take advantage of a free, no-obligation appointment, please call me at 416-626-6515. Or you can visit us on YouTube by checking out our YouTube channel, youtube.com/IronShieldCFP. Follow me on Twitter. Twitter.com/IronShieldCFP. Like us on Facebook, Facebook.com/IronShieldCFP. Or you can connect with me on LinkedIn.